Welcome once again to our commerce classroom. In this session, we will discuss about investment accounting. Investment accounting. Investment means to spend money outside the business in order to earn some income. Investment means to spend money outside the business in order to earn some income. Usually, money is invested outside the business in government bonds, securities, shares and debentures of other companies, etc. Investments are made in two ways, as trade investments and as marketable securities. I repeat, investments are made in two ways, as trade investments and as marketable securities. Firstly, we discuss about as trade investments. The investments which are made permanently for a regular income outside the business are known as trade investments. I repeat, the investments which are made permanently for a regular income outside the business are known as trade investments. These are treated as fixed assets. Trade investments are treated as fixed assets. The profit on sale of trade investments will be transferred to capital reserve account and not to profit and loss account. The profit on sale of trade investments will be transferred to capital reserve account and not to profit and loss account. Then we discuss about investments as marketable securities. Sometimes a business wants to invest its idle cash purely on temporary basis. Sometimes a business may want to invest its idle cash purely on temporary basis. We do this type of investment if the rate of earning is higher than cost of capital. This type of investment is known as marketable securities and is treated as current assets. The profit on sale of marketable securities are transferred to profit and loss account and not to capital reserve. I repeat, the profit on sale of marketable securities are transferred to profit and loss account and not to capital reserve account. Then we have fixed interest bearing securities and variable interest bearing securities. Fixed interest bearing securities. Fixed interest bearing securities mean where the rate of return is fixed. That is 10%, 12%, 15%, etc. Fixed interest bearing securities means where rate of return is fixed. Then variable interest bearing securities. Variable interest bearing securities. Variable interest bearing securities means where the rate of return is not fixed, that is variable. The rate of dividend on shares is not fixed, it is fluctuating. I repeat, variable interest bearing securities means where the rate of return is not fixed, that is variable. The rate of dividend on shares is not fixed, it is fluctuating. Then we discuss about investment account. Investment account. A separate investment ledger is to be opened for each individual class of securities. I repeat, a separate investment ledger is to be opened for each individual class of securities. This is the format of investment account. Our investment account has two sides, debit side and credit side, and then on credit side and debit side we have columns for date, particulars, nominal, interest, principal. The investment account is maintained in a columnar form with three amount columns on each side. Nominal column, interest or income column, and principal or capital column. The face value or nominal value of securities purchased or sold is recorded in the nominal column. The interest or dividends on purchase or sale of securities is recorded in the interest or income column. The third column, capital or principal, reveals the true cost or true sales consideration. I repeat, the investment account is maintained in a columnar form with three amount columns on each side. Nominal column, interest or amount column, and principal or capital column. The face value or nominal value of securities purchased or sold is recorded in the nominal column. The interest or dividends on purchase or sale of securities is recorded in the interest or income column. The third column, capital or principal, reveals the true cost or true sales consideration. Then brokerage and stamp duty. How we deal brokerage and stamp duty in investment accounts? The brokerage and stamp duty are capital in nature. The brokerage and stamp duty are capital in nature. These are to be added with the cost price of investments at the time of purchase of securities, and the same will be deducted from sale price of investment at the time of sale. I repeat, The brokerage and stamp duty are capital in nature. These are to be added with the cost price of investments at the time of purchasing the securities, and the same will be deducted from sale price of investment at the time of sale. As a result, only the net price is to be recorded in the principal or capital column of the investment account. Then we discuss about accounting treatment. Accounting treatment. The accounting treatment of investment depends on the date of purchase or sale of investment. I repeat, the accounting treatment of investment depends on the date of purchase or sale of investment. Firstly, we discuss about when purchase and sale of investments are made just at the date of payment of interest. When purchase and sale of investments are made just at the date of payment of interest. In this case, the quoted price represents the cost of investment. In this case, the quoted price represents the cost of investment. No adjustment for interest is required because the quoted price doesn't include the amount of interest. I repeat, no adjustment for interest is required because the quoted price doesn't include the amount of interest. Then journal entries in the books of investor. Our first journal entry, when investments are purchased. Journal entry, investments account debtor to cash or bank account with the amount of cost of investment. Second journal entry, when investments are sold, cash or bank account debtor to investment account with the amount of selling price. Third journal entry, when interest or dividend is received, bank account debtor to interest or dividend account with the amount of interest received. Fourth journal entry, when interest or dividend is transferred to profit and loss account. Entry, interest or dividend account debtor to profit and loss account with the amount of interest. Fifth journal entry, when investments are sold at a profit. Entry, investment account debtor to profit and loss account with the amount of profit. And sixth journal entry, when investments are sold at a loss, profit and loss account debtor to investment with the amount of loss. These are the journal entries required in the books of investor. Then we solve one problem. On 1st January 2018, X Limited bought 1012% government bonds or rupees 100 each at rupees 94 each. On 1/7/2018, X Limited sold 512% government bonds at rupees 98 each. The interest is paid half yearly on 30th June and 31st December every year. Prepare 12% government bonds accounts assuming market price is rupees 99 per government bonds. This is our question. Then our solution. Firstly, we write journal entries for these transactions. On 1st January 2018, we purchased 1012% government bonds at the rate of rupees 94 each. Journal entry, 12% government bonds account debtor 94,000 to bank 94,000. Then 30th June 2018, interest for this 1 lakh nominal value 12% government bonds. At the time of interest received, journal entry, bank account debtor 6,000 to interest account 6,000. Interest rate is 12%. 1 lakh into 12% into 6 divided by 12, that comes to this 6,000. Then on 1/7/2018, 500 bonds was sold at the rate of 98 each. Journal entry, bank account debtor 49,000 to 12% government bonds account 49,000. Then on 31st December 2018, we received interest for the balance in 12% government bonds account, nominal value 50,000. Journal entry, bank account debtor 3,000 to interest account 3,000. 50,000 into 12% into 6 divided by 12, that comes to 3,000. This is our interest on 31st December 2018. Then on 31st December 2018, we will transfer the interest received and profit on sale of 12% government bonds to our profit and loss account. Journal entry, interest account debtor 9,000, 12% government bonds account debtor 2,000, to profit and loss account 11,000. These are the journal entries required. Then we post these journal entries to our investment account. We draw our investment account in the books of X Limited. 12% government bonds, interest payable on 30th June and 31st December. Our first journal entry, 12% government bonds account debtor to bank 94,000. We post this transaction, this journal entry in the investment account 1/1/2018 to bank, we write nominal value 1 lakh on the nominal column and the 94,000 in the cost column. Our second journal entry, bank account debtor to interest on 30th June 2018. We post this entry in the investment account 36/2018 by bank. On interest column we write 6,000. Then our third journal entry 1/7/2018, bank account debtor to 12% government bonds 49,000, sale of 500 bonds at the rate of 98 each. Then on credit side of our investment account 1/7/2018 by bank, on cost column we write 49,000 and the nominal value column 50,000. Then on 31st December 2018, received interest, bank account debtor to interest 3,000. We post this transaction, this journal entry on the credit side of our investment account 31st December 2018 by bank. On interest column we write 3,000. Then on 31st December 2018 we balance our ledger accounts, balance carried down, nominal value column 1 lakh minus 50,000 we sold, then balance nominal value comes to 50,000. Then on cost column we purchased 1 lakh nominal value for 94,000. For this 50,000 nominal value, 94,000 into 50,000 divided by 1 lakh, that comes to 47,000. Then on cost column we write this 47,000. Then our last journal entry, we know interest account debtor 12% government securities account debtor to profit and loss account. We post this entry in the debit side of our investment account 31st December 2018 to profit and loss account. On interest column 9,000, then on cost column 2,000. This is the solution of our question. I think this problem is clear for all of you. Then our second case, purchase or sale of investment before the date of payment of interest. Our second case, purchase or sale of investment before the date of interest. In the case of purchase or sale of investment before the date of payment of interest, the quotation may be cum interest quotation or ex interest quotation. I repeat, in case of purchase or sale of investment before the date of payment of interest, the quotation may be cum interest quotation or ex interest quotation. Firstly, we discuss about cum interest. Cum interest purchase and sale. Cum interest means including interest. I repeat, cum interest means including interest. That means quoted price includes interest from the last due date to the date of purchase or sale. I repeat, quoted price includes interest from the last due date to the date of purchase or sale. So we have to ascertain the accrued interest during that period and deduct that interest from quoted price to get the amount of cost or principal. I repeat, we have to ascertain the accrued interest during that period and deduct that interest from quoted price to get the amount of cost or principal. Then journal entries for cum interest purchase. When investment is purchased at cum interest, journal entry, investment account debtor with the amount of cost, interest account debtor with the amount of interest to bank account quoted price. When interest is received at the due date, our journal entry, bank account debtor to interest with the amount of interest. Then journal entries for cum interest sale. Journal entries for cum interest sale. When investment is sold at cum interest, our journal entry, bank account debtor with the amount of quoted price to investment account with the amount of principal after deducting this interest, then to interest account with the amount of interest. These are the journal entries required in case of cum interest transactions. Then ex interest purchase and sales. Ex interest purchase and sales. Ex interest means excluding interest. Ex interest means excluding interest. In the case of ex interest purchase, the purchaser has to give to the seller quoted price and interest from last due date to the date of purchase, that is accrued interest. I repeat, in the case of ex interest purchase, the purchaser has to give to the seller quoted price and interest from last due date to the date of purchase. Then in case of ex interest sale, the seller will get quoted price and interest from last due date to the date of sale. I repeat, In case of X interest sale, the seller will get quoted price and interest from last due date to the date of sale. Then journal entries in case of X interest. Firstly, entries in the case of X interest purchase. When investments are purchased at X interest, our journal entry, investment account debtor with the amount of quoted price, interest account debtor with the amount of interest to bank account, total of this quoted price and interest. When interest is received on due date, journal entry, bank account debtor to interest account with the amount of interest. Then entries in the case of X interest sale. Entries in the case of X interest sale. When investments are sold at X interest, journal entry, bank account debtor, total of quoted price plus accrued interest to investment account with the amount of quoted price to interest account with the amount of interest. These are the journal entries required in case of X interest transactions. Then we solve one problem. On 1st January 2018, X Limited purchased rupees 1 lakh 9% government securities at rupees 95 each, cum interest. Face value rupees 100. Interest payable half yearly on 31st March and 30th September. The company sold rupees 20,000 of stock at rupees 96 X interest on 1st June 2018. The company sold rupees 40,000 of stock at rupees 98 cum interest on 1st July 2018. Prepare 9% government stock account in investment ledger on 30th September 2018. Ignore brokerage and income tax. The stock was quoted at rupees 98 X interest at stock exchange on that date. This is our question. Then solution. Firstly, we write journal entries for these transactions. On 1st January 2018, purchase of 1000 securities at the rate of 95 each, cum interest. In that case, received a total of 95,000, 1000 into 95, 95,000. Then we calculate interest for 3 months. 1 lakh into 9% into 3 divided by 12, that comes to 2250. The interest 2250 is included in the quoted price 95,000. So cost of investment is equal to 95,000 minus 2250, that is equal to 92,750. So our journal entry, 9% government securities account debtor 92,750, interest account debtor 2,250 to bank account 95,000. Then on 31st March 2018, interest for 6 months received 1 lakh into 9%, that comes to 9,000. That 9,000 divided by 2, that comes to 4,500. Journal entry on 31st March 2018 for interest received, bank account debtor 4,500 to interest account 4,500. Then on 1/6/2018, sale of 200 securities at the rate of 96 each, X interest. 200 into 96, that is equal to 19,200. Interest for 2 months. For this 20,000 into 9% into 2 divided by 12, that comes to 300. This interest accrued 300 is not included in the quoted price 19,200. So we get a total of this interest and 19,200. 300 plus 19,200, that is equal to 19,500. So our journal entry, bank account debtor 19,500 to 9% government securities 19,200 to interest 300. Then on 1/7/2018, again sale of 400 securities at the rate of 98 cum interest. Amount received 400 into 98, that is equal to 39,200. Interest for 3 months. 40,000 into 9% into 3 divided by 12, that comes to 900. This accrued interest rupees 900 is included in the quoted amount 39,200. So amount of principal 39,200 minus this interest included in it 900, that comes to 38,300. So our journal entry for sale of these 400 securities, bank account debtor 39,200 to 9% government securities 38,300 to interest 900. Then on 39/2018, interest for 40,000 at the rate of 9% for 6 months received 40,000 into 9% into 6 divided by 12, that comes to 1,800. Our journal entry for interest received, bank account debtor 1,800 to interest account 1,800. Then on the same date, 30/9/2018, we transfer a profit on sale of securities and interest received to profit and loss account. Our journal entry 9% government securities account debtor 1,850, interest account debtor 5,250 to profit and loss account 7,100. These are the journal entries required. Then we post these journal entries in our investment account. On 1/1/2018, 9% government securities are purchased for rupees 95,000. In that 95,000, we purchased it on come interest 2,250 is included. So cost comes to 92,750. Then our first entry in our investment account 1/1/2018 to bank nominal value of securities purchased 1 lakh, then interest 2,250 and then cost 92,750. Then on 31st March 2018, we received interest. Our journal entry bank account debtor to interest. So on the credit side of our investment account, by bank 4,500. Then on 1/6/2018, sale of 20,000 nominal value of securities for rupees 19,200 ex interest. Interest amount 300. Then by bank nominal column 20,000, interest 300 and then cost column 19,200. Then on 1/7/2018, again sale of 40,000 securities, come interest, journal entry posted in the investment account. On credit side, by bank nominal column 40,000, then interest 900 and then cost 38,300. Then on 30/9/2018, interest received by bank on interest column 1,800. Then balance carried down 1 lakh minus 20,000 minus 40,000, that comes to 40,000. On nominal value column we write 40,000. Then cost of that 40,000 securities 92,750 into 40,000 divided by 1 lakh, that comes to 37,100. Then our last journal entry, interest account debtor, government securities account debtor to P&L on 30/9/2018 to P&L. On interest column 5,250 and then on cost column 1,850. This is the solution to our problem. I think the solution is clear for all of you. Then we discuss about investment in equity shares. In the case of investment in equity shares, the following additional points are to be noted. First point, when dividend received, dividend is received out of pre-acquisition profit is credited to investment account. I repeat, dividend is received out of pre-acquisition profit is credited to investment account. It is recorded in the cost column only. Dividend received out of post-acquisition profit is credited to dividend column. Dividend received out of post-acquisition profit is credited to dividend column. Then secondly, bonus shares. Bonus shares. When bonus shares are received, it is debited into investment account in the nominal column only. When bonus shares are received, it is debited in the investment account nominal column only. Reason, nothing is recorded in the cost column because bonus shares do not involve any cash payment. Nothing is recorded in the cost column because bonus shares do not involve any cash payment. Then right shares. Right shares are issued to the existing shareholders. When right shares are subscribed by the existing shareholders, the nominal value will be entered in the nominal column and the amount paid on right shares will be entered in the cost column. In the case of sale of right, the amount received on sale will be entered in the credit side of the investment account in the cost column only. I repeat, right shares are issued to the existing shareholders. When right shares are subscribed by the existing shareholders, the nominal value will be entered in the nominal column and the amount paid on right shares will be entered in the cost column. In the case of sale of right, the amount received on sale will be entered in the credit side of the investment account in cost column only. Then we solve one problem. On 1st April 2019, Mr. Anil had 5,000 equity shares in AB Limited. Face value of the shares was rupees 20 each, but their book value was rupees 24 per share. On 1st June 2019, Anil purchased 1,000 more equity shares in AB Limited at a premium of rupees 2 per share. That means 20 plus 2, 22. On 1st June 2019, the directors of AB made a right issue. the terms of right issue were right shares to be issued to the existing shareholders on 25/8/2019. Right issue would entitle the shareholders to subscribe to additional equity shares in the company at the rate of 1 share per every 4 shares held, 1 share for every 4 shares held at rupees 23 per share, the all amount being payable on 31/10/2019. Existing shareholders may, to the extent of their entitlements, either wholly or in part, transfer the right to outsiders. Then, Anil exercised his option of 50% of entitlements under the issue, and the balance of rights he sold to Manoj for a consideration of rupees 3 per share. On 1/12/2019, Anil sold 3,000 equity shares at a premium of rupees 5 per share. Show the investment account. It would appear in Anil's books as on 31st December 2019, and the value of shares held average basis on that date. This is what our question. Firstly, we compute the right shares subscribed. Computation of right shares subscribed. Total number of shares 5,000 plus 1,000. He had 5,000 shares and then he again purchased 1,000 shares. Then total comes to 6,000. Right share is equal to 1 share for 4 shares held. Here 600 divided by 4, that comes to 1,500 shares. Right shares is equal to 1,500. Anil opted for 50%. That means 1,500 into 50%. He opted for 750 shares, and the balance 750 shares. These 1,500 minus 750, balance 750 shares. Anil sold the balance of right 750 shares at the rate of 3 per share. Then our solution. We draw investment account in the books of Anil, investment in equity shares. On the debit side, our first entry 1/4/2019, to balance brought down. Anil had 5,000 equity shares, and the book value of equity shares 24 per share. 5,000 into 24, that comes to 1,20,000. Then on 1/6/2019, Anil again purchased 1,000 equity shares at the rate of 22. Then to bank 1,000. Then on cost column 22,000. Then on 31/10/2019, Anil opted for right shares 750 shares. He is purchased it at the rate of 23 per share. To bank 750 into 23, that comes to 17,250. And on that date 31/10/2019, he sold his right in 750 right shares to other person at the rate of rupees 3. 750 into 3, that comes to 2,250. Then on the credit side, by bank on cost column 2,250. Then on 31st December 2019, he sold 3,000 equity shares at a premium of rupees 5 per share. That means 20 plus 5, 25. Then by bank number of equity shares 3,000. Then on cost column 3,000 into 25, that comes to 75,000. Then on 31st December 2019, we balance our account by balance carried down. On the equity share column, we had 5,000 plus 1,000 plus 750, total 6,750 on the debit column, and from it we sold 3,000 equity shares. 6,750 minus this 3,000, that comes to 3,750. So balance carried down. Number of equity shares 3,750. Then we find out the cost of these 3,750 shares. The total cost of 6,750 shares is equal to our opening 5,000 shares. Its cost 1,20,000. Then purchased 1,000. Its cost 22,000. And then right shares purchased. Its cost 17,250. Then total 1,20,000 plus 22,000 plus 17,250. From the total of these, we deduct the sale value of 750 right shares 2,250. That comes to 1,57,000. 1,57,000. So the cost of 3,750 shares is equal to 1,57,000 into 3,750 divided by 6,750, that is equal to rupees 87,222. 87,222. We write this amount by balance carried on in the number of equity shares column 3,750, and this cost 87,222 on the cost column. Then we balance our investment account number of equity shares total 6,750, then cost column total 1,64,472. Then balancing this cost column, we will get the profit on sale of investments 1,64,472 minus 1,20,000, then minus 22,000 minus 17,250, we get 5,222. Then profit on sale of investment of 5,222, we transfer it to our profit and loss account. Then on the debit side of our investment account, on 31st December 2019 to P&L on cost column 5,222. This is the solution to our problem. I think the topic explained here is clear for all of you. Our investment account, journal entries, adjustments and with problems. The topic explained here is clear for all of you. We will meet again. Till then, goodbye.